Hey guys, welcome. Today I'm very excited to have Ben Leonard. He's going to give you guys a master class on navigating an ecom exit in 2023 and beyond. Welcome, Ben. How are you?
I'm good. It's great to be here. Thanks for having me, Gary.
Yes. It's great to have you back. It's been some time since we last spoke, and I know the whole landscape has changed a lot on the exit side. So I'm very excited to have Ben come in and give us the latest. For those of you guys that are meeting Ben for the first time, he's an alumni speaker at Seven Figure Seller Summit. So I'll let our guest give you guys some time to come in. Meanwhile, if you
Hi,
guys
Ninja.
can, yes, welcome everybody. I see some familiar faces. If you guys can drop your name and where you're joining us from, that would be great. And a quick shout out to Daniel and Annette and Dick. How's it going? Andrea and yeah, well, great. Yes. Okay. All right. So if you guys can please mute your mics first, that would be great. There will be time for question and answer at the end. And yeah, we're having people come in. Welcome to Gavin as well. And let me see. Welcome Andrea from Minnesota. Right. If you guys could please mute your mics. We have an echo effect going on. All right. Um, yeah, excellent. So, okay. So for those of you guys meeting Ben for the first time, Ben is a seven-figure seller and best known as the founder of Beast Gear. He was a millennial entrepreneur, and then he really lived the laptop lifestyle. He was building his business on his laptop, living out of a cupboard in his spare time. And then he grew his business to seven figures and he successfully exited a few years ago, the holy grail for a lot of people. And then after that, now he's working with a lot of sellers, really helping sellers do the same thing, really maximize their exits with his work at Ecom Broker. So I'm very excited because he really has his finger to the pulse when it comes to exits and how businesses are selling, evaluations. So he's really going to give you guys a deep look at the state of ecom exits going on right now. So before we get started, if you can drop your number one question for Ben just in the chat first, just so Ben knows, what are some of your concerns, and then he's going to try to address them in the presentation. It's going to be about 25-30 minutes, and then afterwards we'll have time for Q&A. All right. So, Ben, who is this training for today, and why is it so important?
It is for an e-commerce business owner who is building a brand and they know that they are building that to sell, or they might not even have considered that. And hopefully they're going to learn today that they ought to be considering about an exit plan, and who wants to maximize their deal and therefore is ready to start thinking about an exit now, potentially well in advance of when they want to sell, so that they can build their business in the right way to maximize its value. And it's also for somebody who knows they want to sell potentially quite soon, and it's time for them to get into gear and do the work that's required to position the business as best possible to attract the right buyer and get the right deal over the line.
Excellent. That sounds like a plan. So I know we got a lot to cover today, Ben. So without further ado, would you like to share your screen?
I certainly can. Let me pull up my slides. Can you all see that?
Yes, looks good.
Super duper. All right. Will we go for it?
Let's do it.
All right, then. So navigating an e-commerce exit in 2023 and beyond. A little bit of information first then about me. So I started my first brand in 2016, grew that to $6 million in annual sales, and sold that business in late 2019. It was the first European brand to be bought by one of the new sort of wave of aggregators that came out around that time. Now I'm building new brands, so I still have my feet on the ground in the e-commerce space. I still know what it's like to own and operate a brand. I'm helping others reach their e-commerce goals with consulting and, of course, brokering deals for e-commerce business owners with Ecom brokers. So I'm sitting on a potentially very valuable asset. Is something so many of us as e-commerce business owners find ourselves saying. But unfortunately, the bull market is over, right? The days of a couple of years ago when you'd wake up to have 6 emails in your inbox from an aggregator saying, hey, I want to buy your business. Those are gone. So what do I do? How do I actually unlock all that value in my business that I'm sitting on when it's not a bull market anymore? Well, what we're going to do is we're going to look at who might buy your business, a history of mergers and acquisitions in e-commerce so we can set the scene, talk about what the outlook is now, and talk about a plan, how to actually make your business attractive to a buyer now and going forward. So first of all, let's talk about who might buy your business. Well, the obvious one to begin with is the aggregators, right? Aggregators are roll-ups. They are focused on acquiring e-commerce businesses primarily in FBA. Basically, these guys are looking to acquire brands and make them worth more because they're worth more together as a sum of their parts. They're getting money from equity and debt, private equity firms, family offices, high net worth individuals. And the business model is cash flow arbitrage. So they want to buy my business and Gary's business and your business for a relatively low multiple, stick them together or roll them up, as it's called, into a portfolio where they will immediately be worth more because it is now a larger portfolio and that will have a larger multiple. And then they want to benefit from economies of scale to increase that value even more and then sell them at a higher multiple or go public. Okay. Buy cheap, sell high is the basic model. And they succeed in a couple of ways. Well, actually, the first way is they don't, right? And we've seen this. We've seen this model not work for quite a few aggregators. Certain aggregators have struggled. The brands that they've bought have tanked for a variety of reasons that we can get into later. And some of the aggregators have actually been absorbed by larger aggregators. Or they do succeed. And they succeed because they leverage improved operational expertise and economies of scale to increase the SDE or the EBITDA, basically the profit of the businesses that they're buying. So why did this model come to exist? Well, in theory, it's easy because, of course, Amazon handles 40% of online sales in the US. Third-party sellers, that's you and me, us, we make up about 60% of Amazon's GMV because it's just so easy to use, right? Many of us couldn't have become entrepreneurs years ago, but now all these tools and platforms like Amazon mean that we can get on there. Therefore, it's also easy for the aggregators, right? So many small and medium businesses are coming to Amazon because of that level playing field. And many of us can start a business for 10, 15, 20 grand, right? And so with so many of us starting businesses, the aggregators want to snap us up effectively. They can buy us if they have the funds to do so. And because Amazon is a standard platform where everything is the same for everybody, there's this whole idea of platform arbitrage. They can just apply the same principles to every single brand and product that they acquire, making it pretty easy to scale in theory, right? This is all the theory, yet so many of them have failed. Continuing to look at why then, well, it's pretty easy to optimize. They can optimize spend, margins, and operating costs to increase their EBITDA across the whole portfolio. Each brand is worth more when it's part of a roll-up, right? As I mentioned earlier. They can ruthlessly improve your operating metrics. They're not that interested in your brand. Now, I'm going to contradict that later. They're not that interested in your brand with a small b, but they are interested in brand with a capital B. What that basically means is brand does matter. I'll explain why later. But overall, what really matters is how they can improve the metrics across all the brands that they acquire. Okay. They prefer brands with revenue growth. They want to see that you're growing, you have stable profit margins, and you don't have too many SKUs and only one or two hero SKUs. All your revenue and profit does not want to be reliant on a couple of products. And they prefer Amazon sales because it's so much easier for them to manage their portfolio when everything's coming through one channel. That's not to say there aren't aggregators who are getting more sophisticated and are able to use other channels too. They do exist, and I'm a big fan of them. So where are these guys getting their money? Well, They are getting their money from VC firms, high net worth individuals, the founders of the aggregators themselves, traditional private equity. The likes of BlackRock, Goldman Sachs, Bain, Upper 90 are funding aggregators like Razer, Berlin Brands, Valerio. And as I said earlier, their funding is a mix of debt and equity, right? And it's interesting because aggregators tend to rely on debt more than traditional consumer packaged goods brands. CPG brands typically have sort of 2 times debt to equity, but aggregators can be much higher with lots of debt, like Unibrand, like 90% debt, Heroes, 75% debt, which is pretty interesting. So what has gone wrong for the aggregators? Well, let's look at the history first. The first coming of the aggregators, 2018 to 2021, this cash flow arbitrage model. Basically, they bought everything to see what would stick. They bought a lot of pretty rubbish brands. A lot of terrible business owners with not great businesses got very rich because aggregators were buying pretty much anything they could get their hands on in order to see what would work because they had tons of money. And between 2018 and 2019, they were paying about 3 times sellers' discretionary earnings for an e-commerce business, even pretty poor businesses with no brand identity. And then things went crazy. 2020 to 2021, we were seeing 3 to 6x multiples, largely driven by the macroeconomic environment and COVID. These aggregators could get hold of money very cheaply because of the low interest rates. And this meant they were very willing to buy anything and everything to rapidly grow their portfolio. And as I said, a lot of crappy business owners got rich. So, what kind of fueled all this? And what's been going on since then, actually? Well, sales have been falling, right? The COVID shopping spree is well and truly over, which was not predicted. A lot of aggregators and the investors of the aggregators thought that the boom of COVID moving everything to online was going to stay. Costs have been rising. Production costs, shipping costs. Now, shipping costs are coming back down again now, thankfully. But we went through this period where shipping costs were absolutely insane. Competition continues to rise, right? We're getting more and more sellers coming into e-commerce and on Amazon, and sellers are getting smarter. It's not that easy anymore to outsmart your competitors just by having some new trick in Amazon. You really have to beat them at the branding game and build a better brand. And there's been this sudden aggregator reflection as to what's happened. They realized they lacked operational capability. They lacked foresight. They didn't realize this was going to be difficult. They kind of arrogantly thought that our e-commerce businesses are just a game, right? These aren't real businesses. We'll just roll them up and make bank. It's easy. You just sell stuff on Amazon. And they've had a lack of talent. They've not been able to hire the talent because the talent doesn't want to work for them. The talent wants to build a brand like us and then sell it. And there's been a failure to integrate owner expertise. So the owners have built a fantastic brand, the aggregator acquires it, and then immediately stops doing all the fantastic things that the owner was doing to make it good in the first place. Ask me how I know. There has been a huge reliance on Amazon.
How do you know? How do you know, Ben?
Well, Gary, put it this way. The organization that bought my brand hasn't kept doing all the wonderful things that made the brand attractive to them in the first place. And then they scratch their head as to why it's not performing well. And we see that across the board with so many aggregators. But thankfully, they are getting better now. They've been learning their lessons, and I'll talk about that in a bit. So they bought these brands when Amazon was easier. And then over time, as Amazon has got increasingly harder to rank, harder to get reviews, it's more of a pay-to-play platform. That, of course, means the environment has changed. So those brands that they bought in the old environment can't survive in the new environment, which is why aggregators have struggled, or one of the reasons. Well, so what? What does that mean for us now? Well, let's look at the second age of the aggregators, 2022 to now, okay? We've been through a big correction, all right? There's been a massive shift in aggregator strategy, which is good for everyone in the long term. They've refocused on improving their operations and getting their house in order, and many of them really pulled back on acquiring brands. Far fewer acquisitions, less often, which means lower multiples, and way deeper levels of scrutiny. It's much harder to get a deal over the line now. And so if you're trying to sell your business now and due diligence is taking a long time and is going into incredible detail, you can thank everybody who sold their business before you, because every time an aggregator has done a deal and got burned, they've added more levels of scrutiny to their due diligence. There you go. I kind of said it before I showed it, right? It's harder to get deals over the line now, which is why it's really important to have a great intermediary, a great broker on your side to run the deal for you. Basically, only great brands will get acquired now. The days of people with some crappy Me Too commodity, doesn't even have a brand name, just selling stuff on Amazon, selling their business are over. It's just not going to happen. You have to have a real brand. So that's the aggregators. Who else might buy your business? Well, private individuals. They want a head start into e-commerce. They'd rather buy and then build, or buy and grow rather than start their own thing. They might be doing a micro roll up either on their own or with other private individuals, basically copying the aggregator model, but at a smaller scale and arguably more sustainably and more smart. And the funding might come from personal savings or loans, perhaps SBA loans in the US or acquisition finance. Then there are strategics. These are organizations that are actually in the same niche as your brand, and they want to bolt you on to what they're already doing. So, for example, you might have a family of luxury clothes and home brands, and it makes sense for them to bolt on your luxury watch brand. Okay. Typically, strategics are only going to come after you if you're doing at least £1 million or dollars in EBITDA, or it's not profit, but for the purposes of this webinar, we'll just call that profit. So, market outlook. What's going on? Well, 2023 is still a buyer's market. They're paying less often, and they're often buying distressed assets where they can improve operations. But if you have a strong brand, you're still going to get a great multiple. It kind of doesn't matter what's going on if you have a fantastic brand. Yeah, that's going to be the key in all this, and I'm going to keep coming back to this. Interestingly, we're seeing more recovery among European buyers. European buyers seem to be more active in their buying and more active in their fundraising as well. So what does that mean for you and me as e-commerce business owners? Well, we want to sell our business for big bucks, but the market is down. What do we do? Oh no, nobody's going to want to buy our business, are they? And it's really hard owning an e-commerce business. It's stressful, it's time consuming, and my business is full of potential I can't actually get to because nobody wants to buy it, right? But that isn't necessarily true. Your business can be attractive to a buyer if you treat it like a legit consumer packaged goods brand. How do your favorite brands look and feel and behave? Ask yourself that. Your favorite brands related to your hobbies, your profession, the food products in your cupboards. What are they doing, and how can you apply that to your business? Remember what buyers want. Here's what they want. They want sustainability. They want a business that is going to last into the future. They want growth potential. They want a business that has been growing and that they can keep growing, perhaps by adding more products that you've developed, by taking it into international territories you haven't been into yet, or onto more channels. They want intellectual property. They don't want anyone to just come in and be able to copy your products or copy your brand. They want a real brand that is protected by trademarks and patents. And they want repeat customers. You need to have a tribe of raving fans who will buy all your stuff every time you launch a product, rather than just widgets being sold on Amazon. Brand gives you that. Brand gives you all of that, right? Selling generic stuff gives you none of that. And that is why brand is at the base of the value pyramid. And this is a model that we created in Ecom Brokers. It represents the 5 components that are most important to a potential buyer when they look at your business. And I would say a business needs at least 3 layers of this pyramid, which I guess you could say is kind of like a Mayan pyramid. It's definitely not an Egyptian pyramid. You need at least 3 layers of this pyramid to be in good standing for your business to be sellable, right? Pick 3. But really, the strongest layers are at the bottom: brand, and then growth and profitability. And when you get that right, the value of your business gets much bigger. Brand is the most important layer. When you have no brand, the value really diminishes. And we'll get into that a bit later. But for now, just ask yourself, how are these layers for your business? Is it growing and profitable? Is it risky and built in a house of cards? Is it transferable? Could another organization pick up your business and just run with it now? And do you have access to all the documentation that they would be looking for when they're doing their due diligence? We'll get into this a bit more later, but I just wanted to set the scene, show you that right now, okay? But you don't have to sell to an aggregator. Remember that, right? Because when you go through a thorough, patient, and deliberate process, you can sell to private equity, you can sell to family offices, you can sell to competitors, you can sell to micro aggregators, and you can sell to strategics, right? Running your business is really hard. I know what it's like to be spinning all these plates, maybe still working a day job. Being an e-commerce business owner isn't that easy. It certainly isn't a get-rich-quick scheme that some gurus would tell you it is. But when you sell your business, it can change your life. When you do that, you can have the lifestyle and freedom that you want, travel and spend more time with your family, work on new projects. That's the number one reason people come to us to sell their businesses because actually they're more interested in a new project and they want to sell their first business and get money to fund their new idea. So ask yourself a what if question, right? What if I set up my business to be an attractive acquisition target, and think about that from the start, or from now at least, and take it through a real mature mergers and acquisitions process, right? You have a real business here. It deserves a real process, and marketed it to a wide buyer pool. That means aggregators, private equity, family offices, competitors, everyone who might want to buy it. If you did that, would I eliminate the issue of the market? Because regardless of the market, I've built an attractive business. So forget the fact that you're not getting 6 emails from aggregators in your inbox every day. And just the fact that you've got a great business means there will be a buyer there, right? Would you then realize the true value of the business because you've taken it through a mature process to actually work to get the business where it needs to be to maximize its value? And would you sell it to the right buyer who will succeed? We've seen so many issues where businesses have been sold and there's been all these earnouts not hit because the new owners have failed. But if you sell to the right buyer who you're highly confident will succeed, you can actually continue to enjoy upside after you've sold your business. Whereas if you don't set the business up to be a real brand with a real brand identity, then either you're going to get no sale or sell for less than you desired. If you don't sell, you might be lumbered with a business you no longer want. And you might not get the exit you need or want or deserve. Some people really need this exit to be able to fund the other things in their life that they're trying to do, or they need to get out of this business because it hasn't turned out how they wanted to, and their life circumstances mean they either need to sell this or shut this down. And really, they ought to be selling it. So if you don't sell through a mature process, then you might end up working with a poor service or no service at all, with a real lack of planning. And you'll get that with no service if you try and do it yourself, or with a poor service. Your business is going to end up getting undervalued, and you're going to get a really poor deal structure. And that's really important. I said before about those earnouts not getting hit. Well, if you get the deal structure right, you can protect yourself, and your broker and your lawyers can protect you by ensuring that even if earnouts aren't hit, you don't suffer too much, because it's not your fault if the buyer doesn't run the thing the right way after you've sold it. And if you don't sell to the right buyer, and the new buyer screws up the operations, then your earnout is impacted. Again, that can happen if you take it through the wrong process. Because trust me, I've been there, right? In late 2019, I sold Beast Gear, and I chose the wrong process. I chose a generic flipping website, and they incorrectly calculated the SDE, or the profit, and they were ready to go. This had been through their entire quality assurance process, and it would have cost me about $500,000. I should have, and the broker should have, negotiated the deal better. The deal was quite good, but it wasn't tight enough. The earnout structure could have been tighter. The side agreement that I had agreed on, my profit share, could have been better. And it should have been written into the contract that I would get access to the data so I could step in before problems arose. Now, I was lucky, right? I didn't lose that $500,000, because in the end, my now business partner in Ecom Brokers, she and I tidied everything over and fixed it. So I should have done better due diligence on the buyer as well, right? They talked the talk, but ultimately they operated the brand poorly for the reasons that I spoke about earlier, that so many of these aggregators have suffered with. So now I've seen what happens with all the deals we've done when you get the process right, you get the deal right, and you get the right buyer. So I have a plan for you. And the plan is quite simple. You're going to treat your business with respect. It's not a side hustle. It's not just an Amazon account. It's a real legitimate CPG brand. So the first thing you're going to do is strengthen your brand. And then we're going to take that brand through a real process to get the right deal with the right buyer and get the exit you deserve. So let's start with strengthening your brand, okay? Why does brand even matter? Well, I said before that brand is at the base of the value pyramid, right? And we spoke about that. So let's dig into that a bit more. Why does brand even matter? Well, with no brand identity, there's no hook, no excitement. There's nothing that, there's nobody's waiting at the letterbox for your product to arrive. Nobody is deciding deliberately not to order your competitor's product, but actually waiting for you to launch yours because they want everything by your brand. There's no repeat custom. There's no external assets. There's no pride in being seen and using your brand. Think of like an obsessed Harley Davidson fan, right? Think about how you feel about your favorite brands. That's how you want people to feel about your brands. So with my first brand, Beastgear, we had significant value in the brand. We had a cult-like following of fans who'd buy any product we launched, which was attractive to a buyer. If we had just been a generic slap a label on it brand, that would have given us nothing. But Beastgear as a brand gave us everything. And I'm going to repeat what I told you earlier. Remember what buyers want: sustainability, growth potential, intellectual property, and repeat customers. Brand gives you that. That's why it's at the base of the value pyramid. Now, some people will be saying, but Ben, my business is doing pretty well. I could sell it for quite a lot of money. Does brand really matter? It does. Let me walk you through an example, okay? Now, this might look overwhelming, but let me take you through this. We had two businesses. This is just, we've seen this multiple times, right? Here's just one example, right? Two businesses, both with sales discretionary earnings of about 450 grand, right? And if you're not familiar with what sales discretionary earnings is, don't worry about it. Just think of it as profit for now. And one of the brands, or one of the businesses, had a great strong brand identity, and one was just selling stuff. Well, the one with the great brand identity went to market with a multiple of 5.55x. That's a $2.5 million price tag. And the other one with a poor brand identity, or basically no brand identity, 1.4 million. They were both selling like the same products virtually, but one had built a great brand and one was just selling stuff. Not only is that over $1 million difference at the time of the sale, but if you put that $1 million difference into an 8% sort of low, medium risk stocks and shares portfolio, that's worth over $1.5 million after 5 years and $2.25 million after 10 years. So that really does matter, right? So people shouldn't scoff at this. This is important. And, right, actually, let me just go back up 1 second there. Not only, there's $1 million difference there. Actually, you know what? The difference might have been even more, because the brand that was just selling stuff, frankly, was lucky to sell it all, right? So many of these brands or businesses now that don't have a brand identity just won't sell. So that's an even bigger difference. All right, so let's talk about a real mergers and acquisitions process, okay? When you take your business through a real process, you get the right deal with the right buyer. Let's talk about what a real process looks like, okay? A real process gives you maximum valuation. A real process helps you to increase your EBITDA. It's not profit, but just consider it profit for the purposes of this webinar, right? And the value perception. Optimizes your operational costs, optimizes your marketing, helps you automate, outsource, streamline your business. A real process helps you to improve your customer loyalty, diversify your product offerings, your channels, your markets, your traffic, and increase your brand visibility. Now, some of you are going to be saying, how does that work? How does a broker do this? Don't you guys just like list my website for sale? No. A real process could be many months, could be 6 months, could be 2 years to work with you. And when you work with a good broker who has experience on all sides of the equation, owning and operating e-commerce businesses, former Amazon employees, former aggregators, mergers and acquisitions experts, and accountants, they can actually work with you on all of these aspects, everything from product development all the way through to marketing your business on the back end to your customers. And that's how they maximize the value of your business, not just by kind of saying, well, give me your numbers and I'll slap it on a website and try to sell it. A real process gets you the right deal and the right deal structure from planning to sign off, right? And gets you the right buyer. And that includes interviewing buyers. It's not all about the buyer interviewing you and doing their due diligence on you. It's about you doing due diligence on the buyer. And a real process gets you expert valuation, which is made up of financial analysis, of course, but also deeply understanding all the other parts of your business, your operations, your market, your history, what opportunities there are for a new owner of your business. And all that gives you maximum value, all right? And a real process gives you expert positioning. It means presenting your business to the right buyer who has the operational chops and who will present a favorable deal. When you work with the right broker, they understand who these buyers are and get your business in front of the right buyer that is actually going to make a serious offer. The right process will spin your business the right way. So, for example, you might have a business that's pretty low growth, and that's not very exciting, but you have great margins. So the right process will talk about the margins. Or you might have a business that's slowly growing, which is good, but doesn't have, it's growing very quickly, but doesn't have great margins, right? You'll talk all about the great growth. And the right process will package the business properly so that it is ready to go. Okay. And that includes helping with the due diligence. You shouldn't be on your own when you're doing your due diligence. And that really matters because when a buyer is doing their due diligence, let's say a buyer has got money to spend, right? And they're eager to buy a business in your niche, and they're looking at your business and somebody else's. And your business has been through a great process and is neat and tidy with a ribbon on top, and you've had a lot of support on the due diligence from your broker. Well, guess which business they're going to want to spend their money on, because yours was so much sweeter to deal with during due diligence, and anything they did find that they didn't like was a much sweeter pill to swallow. So when Dave in acquisitions is presenting that to his investment committee, they're much more likely to go for your business when it's packaged up properly. The right process will give you expert guidance, right? Selling is an emotional journey, but it's really important to separate emotion from decisions, right? A good broker will not only manage your expectations, but they will be a buffer between you and what's going on and help you to take a step back and think about things rationally and methodically, right? And so you need that guidance to come from experienced guides who understand e-commerce. They own and operate their own brands, understand mergers and acquisitions, understand accountancy for e-commerce, understand what it's like to sell their own business, and understand what it's like to buy a business, and understand the buyer's perspective, because it's not all about you. A lot of people, they're coming to us and they're like, how much can I sell my business for? And I say, well, that depends how much somebody's going to give you for it. Because at the end of the day, you can't sell your business unless somebody else buys it. That's why it's called a deal. So we need to get into the buyer's shoes to understand what they want so that we can operate in a deal that is in the zone of fairness, so that we can get the deal over the line and get your business sold so that somebody else buys it, if that makes sense. So look, the process could be 3, 6, 9 months, or even 2 years out, right? But the right broker will work with you on an appropriate timeline to get you ready to sell. Now, that's going a bit too far and a bit beyond the scope of this, but let's just assume that we've already been through that process and you're kind of ready to sell now, ready to take it to market. I've put this bit in because people ask me about this all the time. So here's what it kind of looks like from you're good to go. You should have had an initial valuation, and your broker should have performed an in-depth analysis of the financials in tandem with working with you to really understand the business process and the niche and the intangibles associated with the business. And they're going to prepare a detailed prospectus, which basically jumps up and down and shouts about how wonderful your business is, present it to the market, having identified the right buyers. Ideally, you're going to have several interested parties who will submit something called a letter of intent. It's a non-binding letter that says, we intend to buy your business roughly for these terms. And at this time, some soft negotiation takes place across these potential buyers to get the details of this LOI appropriate. And there may be mergers and acquisitions attorney brought in at this stage. So you accept an LOI, okay? And your broker should help you prepare for due diligence. And that takes, 4 to even 12 weeks. Anyone telling you 2 weeks is lying. You hear these stories of sell your business with us. We'll have the money in your bank account in 30 days. That is a lie. And actually, you don't want, that is a red flag for run away. That is not a good process to take your business through. That's being really disrespectful to your business. Negotiation and sign off on the actual deal, which is called an SPA or an APA, is going to take 1 to 2 weeks. So an SPA is a share purchase agreement. That means they're buying your entity, your LLC, or your limited company. And an APA is an asset purchase agreement. That means that you're keeping your company, but they're buying the brand out of your business. The buyer will wire money to your attorney. Your attorney receives the money. And you and the buyer work together to transfer the business from you to the buyer. So that might be your Amazon selling account, your Shopify account, any other places that you're taking sales. Your attorney will transfer the money to you. You will uncork the champagne, of course, but you're not done yet. You got to provide transition support to the new owner. So the exit you deserve can change your life, right? Start planning now. Find out what your business is worth now, and then reverse engineer that exit with suitably qualified experts. And remember, your business can be an attractive target to buyers if you treat it like a real CPG brand. Selling to a generic aggregator isn't your only option. Selling your business can change your life if you do it right. So treat your business with the respect it deserves. Thank you. If you head to ecombrokers.co.uk/7FSS for Seven Figure Seller Summit, there's a form there where you can put in some basic details about your business, and we can get on a call and have a free consultation about how we might be able to help you plan your exit, whether that's in a few months' time or even 2 years' time.
Excellent. Thank you very much, Ben. And I encourage you guys to check out www.ecombrokers.co.uk/7FSF to get a free consultation and also business valuation, or even if you just have any questions about, getting your business, tidy up or exits. All right. So we have some time for Q&A. So I see there were a couple of questions in the chat already. So we'll get to those in the order that they were received. And so let's get started with the Q&A. I have a couple of questions as well. So let's start with Andrea's question earlier. And if Andrea or whoever has a question would like to unmute your mic or get on video, I think it's a valuable time to be able to speak with someone like Ben who successfully exited and has been through this a number of times. So Andrea asked earlier, if you're just starting out, what are some things to keep in mind for ease of maximizing an exit?
Yeah, good question, Andrea. So I would come back to, and actually there's a couple of useful, obviously I'll answer you here, but you can read in your own time as well. A couple of useful articles on our website. So if you go to our website, click on Learn. There's one there about the value pyramid that I mentioned earlier, and there's another one there about the 7 foundations of value. Both useful models that we use in ecom brokers. So the value pyramid is a really good one because it's something that we use to help business owners conceptualize what matters to a buyer. They care about brand, they care about growth and profitability, they care about risk, transferability, and documentation. So from the very start, you want to be making sure that you're not just selling stuff, that your business is actually represented by a brand. So what is a brand? Well, a brand is a group of products that solve problems for a particular group of people. That could be professional dentists, it could be amateur scuba divers, could be knitters, right? And branding is how your business makes them feel, and marketing is how you tell them about it. I've got a whole bunch of content about that, but really that's what you want to be aiming for, is a business that actually means something to people. And it's getting into a branding and marketing webinar to start talking about that. So I'll move on from there. Your business obviously needs to be growing and profitable. So we want to see EBITDA margins of 15 to 20%. Really, 15 is really the minimum. 10 at an absolute push, but really they start getting excited above. Buyers start getting excited when your EBITDA margins are above 20%, and your business needs to really be growing. We want sort of year-on-year growth of really 30% plus. And your business is, in terms of the size, you'll really start to get interesting to institutional buyers when your profit is 500 grand and above. That's not to say you can't sell when you're smaller than that, but really most institutional buyers are looking above there. And then it's about
USD. Is that USD or pounds?
USD. I mean,
okay.
These days virtually the same, aren't they? We want to make sure that the deal is de-risked for a buyer. So what does that mean? Well, they don't want to buy something that is a fad or highly regulated or about to become highly regulated or about which there might be safety concerns. Certain buyers will actually move into these areas on purpose because nobody else is and they want to specialize in that. But I would not recommend getting into any of those kind of areas. I also wouldn't recommend dabbling in anything black hat. I would recommend protecting your business with intellectual property. Then it's about transferability. Your buyers or potential buyers are going to want to buy a business that they can pick up and run with. So, I really recommend everybody goes and reads the early 90s classic, The E-Myth Revisited by Michael E. Gerber, which is like the business Bible on systems and processes. It's really easy to understand. I read it like twice a year. The original was just called The E-Myth, but the revisited version is even better. And finally, it's about documentation, right? During due diligence, a buyer wants to turn over every stone and look in every nook and cranny of your business to make sure that everything is as it should be. And who can blame them? They're potentially going to part with a lot of money. So you really want to be making sure you have great record keeping from the get-go. That could be your certificates related to your products and your suppliers. It could be your tax filings and your accountancy records. Anything and everything associated with your business should be neatly filed so that I can say to you, give me this document from 2 years ago, and you can very easily just go and get it. And it's not that difficult to do. And actually, when you run your business this way, thinking about what the buyer wants, the happy side effect is it becomes easier to run and therefore more efficient. And it actually will get bigger quicker, which is great.
Excellent. Thank you. And the next question we have from Annette. What are the different broker fees?
Sure. So I'm going to put a link into the chat here to a page where we talk about the different kind of options that you have when you're selling your business as to who might buy your business, right? Or who the different route that you could take when you're selling your business. Now, different intermediaries have different fee structures. I would be very wary of an extremely low fee that sounds like it's too good to be true, because literally, if it's a very low fee, that means they're not going to be doing very much work, because economically that just isn't going to work, right? Somebody has to get paid to do the work, which means they're probably doing very little other than just sort of forwarding your business to a big list of buyers, which that's not good enough. You have a real business. You deserve a real process where they're going to work with you to maximize the value of your business. Now, don't be afraid of a slightly higher fee either, because if it's a higher fee, and if you have a good feeling about the broker and build trust and rapport with them when you're having conversations with them, then they ought to be more than paying for themselves in their fee. So they're, the value they add to the deal ought to, be sort of paying for itself, if that makes sense, right? So at Ecom Brokers, we have like a sliding scale of fee. We have two ways that we do it, right? We have a more expensive way, where the bulk of the fee is on a success fee on the back end. And we have a cheaper way where you pay us a little bit more upfront, but we take a smaller success fee. And the reason we have this flexibility is because everybody's business is different. We are a bespoke boutique firm who take our sellers seriously. So we present you with options because we believe that, you've got the brain power to determine what is best for you and your business, and we'll help you figure that out. So that's really important to understand. A lot of these services are charging an astronomical rate for not very much, and some of them are charging really very little, and that's a red flag because they're doing very little. It bears mentioning here a business model that has emerged recently, which is really quite concerning. There are these marketplaces that have come about, and they claim not to charge you a fee. And it's extremely dishonest because they do charge you a fee. Here's how it works. They charge they put you on what they call a marketplace. So immediately they're kind of relegating your business to just a garlic press on Amazon, right? Rather than a real business. And buyers bid for your business. And they claim that the buyer pays the fee. Well, if the buyer is paying the fee, that means the buyer is the client. And all service providers have a duty to their clients and want to give their clients the best possible experience. So what does the buyer want? The buyer wants a cheap deal. So these marketplaces business model is literally sell your business fast and cheap to bring in more buyers. And on top of that, the buyer is just going to chop off what they would have paid you. So it's a really awful model. So just be aware of that. And if you're thinking about, oh, this looks good because there's no fee, it's a huge red flag.
Yeah, that's a really good point. I mean, if it sounds too good to be true, it usually is.
Yeah, exactly.
All right. And our next question is from Pez, who asks, how are your experiences with Amazon brands exits for owners located in Germany? Is there something special to consider? Thanks.
Great question, Pez. Um, Fortunately, we live in a connected international world and we can work with sellers all over the world, and that is what we do. Special things to consider would be specific laws to Germany, which is why we will connect our clients with mergers and acquisitions attorneys for their deal, depending on their geography, right? So, for instance, if you are a client of ours in Mexico, we'll connect you with Mexican legal representation. If you're in Germany, we'll connect you with German legal representation, and so on and so forth. It's also important that you consider and that we work closely with your tax advisor in Germany to understand if there's anything special that we need to think about. So, for example, in the UK, we have something called entrepreneurs relief, where you only pay 10% tax on the first million of a business that you sell rather than 20%. So we make sure that that is taken into account and we understand what is going to be the best deal structure or a way of selling the business for the business owner. So, for instance, most sellers in the UK want to sell the limited company. We will work with German tax advisors, French tax advisors, Mongolian tax advisors to understand what is going to be appropriate for you and your business and therefore set it up right for you. Hope that makes sense.
Excellent. And I'm curious, Ben, when it
Mm.
comes to, now one of the hot topics is AI and ChatGPT. And, you mentioned there's like this tax scheme that you mentioned earlier. I think it's the Entrepreneurs Relief Act in UK. Are there, I mean, are you using AI, ChatGPT to try to get an upper hand on this, or do you recommend that people watching this out there, they can leverage AI to maybe they don't have the resources to speak to a professional yet, but is ChatGPT a legitimate resource to get smart about this, or
Yeah,
should they be wary of hallucinations and false information?
they really should be aware and wary of that. That's why there's a disclaimer on the ChatGPT page that says, you know, we literally spit out false information. There have been cases where people have just for fun asked ChatGPT about themselves, and it's
Yeah.
written back something horrifying and completely defamatory, and they've had to take legal action because they're concerned that other people might do the same thing. Um, so it can't, AI is a very useful tool, but when it comes to real mergers and acquisitions and that kind of thing, I wouldn't be trusting it to write a contract for me, or I might use it as like a general guide to point me in the right direction, but I would want a professional, whether I'm talking about tax or intellectual property or my accounts or whatever it is. You need to have all the I's dotted and the T's crossed by professionals who know what they're doing.
Yeah. Yeah. That makes a lot of sense. All right. So we have a time for a couple more questions, guys. If anybody would like to raise their hand or drop a question in the chat before the end of the hour, now is your chance. Meanwhile, I had a couple questions, Ben, in terms of multiples. Now, obviously, we're down from the peak season during the COVID bump. What kind of multiples are you seeing nowadays in the marketplace?
It's a great question. I'm smiling because I get the question a lot, and I'm going to sit on the fence with the answer. I'll give you an answer, right? But let me explain. The answer is between 2 and 6, right? Now, that is a really vague, broad answer. I know that. I'm the first to admit it. But here's why. It's not all about, first of all, it's not all about the multiple. It's about the deal and the deal structure. But also, there's so many factors that go into determining the multiple. Just recently, right? We had a business which was doing only 194,000 in SDE, right? And I said earlier that you're probably not going to be of interest to institutional buyers until you're doing at least 500,000, but this was only doing 194K. It went for a 5.15x. On the other hand, not long after, a very similar business selling very similar products doing close to 500,000 only went for like 3.2. So why did the smaller business go for a much bigger multiple? Well, The smaller business had a much stronger brand identity, had a ton of products in the pipeline, had better intellectual property, had built a small but dedicated legion of fans, was of strategic importance to the buyer who really wanted to bolt that into their existing operations and had a plan for it, and who had capital to deploy and needed to deploy it right now. So all the stars aligned. The other business was pretty good, and I would say that a 3.2 was a fair multiple for that, to be honest. The majority of deals for the majority of people selling an e-commerce business right now with 6-figure to low 7-figure profits is going to go for between 3 and 4x. Some will go for 5 to 6. Still pretty vague, but I've narrowed it down for you a bit there. But multiples are not as sexy as people think, and what really matters is the entire deal. You know, we've had deals for where the buyer has wanted to get as much money up front as possible, and we accepted a lower-ish multiple, and they got 100% cash at closing. And the buyer was happy with that because that's what they wanted. On the other hand, we've had businesses where the buyer knows this thing could go to the moon with the right resources behind it. And they say, I'm willing to take less up front and have more on the back end and take a lower multiple for a different deal structure, right? So it's about the whole deal. It's not all about the multiple. Does that make sense?
Yeah. Yeah, that makes sense. That makes sense. Definitely there are some things that would put the business on the high end, strong brand identity, projects in the pipeline.
Yep.
I'm curious, what about, I've been reading more about buyers looking for diversification away from Amazon. They don't want just like 100% Amazon business,
Yep.
perhaps in different markets. What are you seeing nowadays?
Yeah, I mean, I said earlier in the presentation that so many institutional buyers, aggregators in particular, want to see Amazon dominating the sales. That is still true for a lot of them, but more of them are getting more sophisticated in their ability to handle off Amazon sales. So that means your own direct consumer website. It means other marketplaces like Walmart. It means wholesale marketplaces like Fair and Tundra. It means selling into retail. And by definition, if you're treating your brand like a legitimate CPG brand, then you are going to diversify the sales channels, right? And if that means that you're cutting out some of the generic aggregators from your buyer pool, then so be it. That's great. But you're also cutting in more sophisticated buyers who are impressed that you're treating your business like a real brand. And ultimately, if you want to grow your business, you're going to have to diversify.
Yeah. Yeah. Ben, I was just reminded of something. I think some brands, some sellers, they kind of know what to do, what they should do, but they're not doing it, right? Like with the brand identity, products in the pipeline, etc. And I believe you're offering a mentoring program. Is that correct? Or like
Oh,
an
yeah, we
advising
absolutely are.
program?
Yeah. So
Yeah, is that,
you're
could you
completely right.
share more about that for people that might be interested?
Yeah, Ecom Brokers has a mentored route to exit. So we increasingly see people come to us and they're not ready to sell, either because they know they're not ready to sell, but they just want some advice, or they think they can sell and we have to deliver the news that you ain't ready to sell. But because we have, experience across the board, we are brand owners, we've bought brands, we've sold our own brands, we're ex-Amazon, we're ex-aggregators, we're accountants and mergers and acquisitions experts. That means we're in a great spot to mentor people on every aspect of their business, whether it's product development to understanding their cash flow to building chatbots, right? Everything. So we will work with people to mentor them until they're at the point where they can sell. So you pay a monthly fee. We have calls with you and offer email support as well. And we're actually building out a little course and a little community that you can join too. That's not quite ready yet, but it will be. And then when we sell your business, we actually credit half of what you paid us in mentoring fees back to you against our final commission for selling the business. So that's pretty attractive as well. Plus, our mentoring fees are an add back. So it's not quite free money, but it's the closest you're ever going to get to free money, right? The fee that you pay us on a monthly basis, when somebody else buys your business, they're not going to be paying that. Obviously, we're not going to be mentoring them. So that comes off the loss part of your P&L sheet. It is an add back or an adjustment, if you will. So it doesn't depress your profit, which means it doesn't detract from the value of your business. In fact, it's only going to add to the value of your business because, of course, the point of the mentoring is to help you grow your business.
Excellent. And can people find out more about that at the same link you provided earlier?
Yeah, absolutely. Just go to that link, and then when you fill in that form, you might be we'll be in touch. It might be that
Mhm.
you're somebody who's great for mentoring. It might be that you're more somebody that we're just going to work with to sell your business in 9 months' time. The thing is that because we're a boutique and bespoke firm, we're enablers. We find a way to help you, rather than like a one size fits all. Slap it on the website, list it, try and sell it kind of thing.
Mhm. Okay, excellent. So I just dropped that link in the chat again for anybody that wants to check it out. We have time for maybe one or two quick more questions. If anyone has questions, feel free to drop in the chat. I had a follow-up question when it comes to valuations. In terms of supply chain, we're seeing, there's a shift going out of China. Even big companies like Walmart, their policy is demanding diversification outside of China. They want to see more from like countries like Vietnam, India, etc. How much does supply chain matter when it comes to,
Oh yeah.
the valuation?
Yeah, it's
Mhm.
a really interesting topic right now. I'm sourcing a product in Vietnam. I'm building one of my other brands out of manufacturing facilities in Pakistan. I'm currently not manufacturing in China. I've just come back from a visit to Vietnam. These places are really exciting. I'm not anti-China whatsoever, but I am a big fan of zigging where everyone else zags. And human rights issues in the west of China concern me at the moment. I'm also not. I'm glad that when inevitably China invades Taiwan, I'm not going to be sourcing there. I think that the sanctions that come in are going to be a big deal. And currently, of course, there's the Trump tariffs. So I'm not saying immediately panic and like get out of China, but I'm also saying if you have the opportunity to look elsewhere, then look into that. It's always good to not have all your eggs in one basket.
Yeah, definitely. All right. Last question. Looking into your crystal ball, Ben, what are you seeing in the next, let's say, 6 to 12 months when it comes to exits and the whole, state of the Amazon seller
Yeah.
ecosystem?
I'm quite bullish. I feel like things are on the up. Buyers are we've heard from some of the big boy early aggregators who completely pulled back on buying, and they're kind of back in acquisition mode. Um, Multiples I don't think are going to go crazy like they did before, but equally, if you have a fantastic brand with great IP, it's growing like crazy, and the right buyers there for it, you can certainly sell your business for a high multiple. Um, One thing that I'm really seeing more of now is actually e-commerce business owners like us, the kind of people on this call, are not selling, they're buying. They're eating up smaller businesses that make sense, mini strategic bolt-ons for them. That's really interesting. And I'm seeing a much bigger emergence of micro aggregators and private individuals acquiring brands. Um, Deals are still being done less often. What's really going to be exciting is when inevitably one of these aggregators goes public. Thrasio nearly did it about 2 years ago now. Didn't happen. But when one of them does, it will really finally prove once and for all that the model works. I slammed aggregators a fair bit at the start of the presentation, but that's really just because we went through this period where they did kind of suck. But so many of them have got their act together now. It's like anything. You have ups and downs, and they've kind of gone through that and come out the other side, many of them. Not all, none of them are perfect still, but when one of them finally goes public, it will prove that the model works once and for all. Tons more money will pour into the space, which means it's going to be great for sellers like us when we want to sell our businesses.
So we're waiting for that, for one
We
of them to
are,
go
we
public.
are, yeah,
Yeah, that
yeah,
would
yeah.
kind of be the tipping point. All right. So what's the best way for people to reach you, Ben, if they want to follow up?
Absolutely. Ecombrokers.co.uk/7FSS is probably best for now because we will follow up to that. You can also email me, ben@ecombrokers.co.uk. I'm on LinkedIn as well. Just look up Ben Leonard. And in fact, because this is a Zoom call, I could just put a bunch of links in here in the chat, right? There's my
Yeah.
LinkedIn, there's my Instagram, that's my YouTube. Um, what else have we got? Um,
Your email, I dropped it in as well.
there you go. There's the podcast. So it's a mix of sort of, I've put there, the top link is, so, I wear my Ben hat and my ecom brokers hat, right? So benleonard.pro/book. I've got a book coming out in October called Quit Stalling and Build Your Brand. You can sign up for the waiting list there. There'll be bonuses there. You put my email address in there. That's great. Yeah, click on those links, guys, and there's lots of fun stuff on all those things. And I'm very approachable. I'm happy to have a chat. So yeah, get in touch.
Excellent. Well, thank you very much, Ben, for giving us this masterclass on the state of ecom exits in 2023. So it looks like the opportunity is still there, but we have
Oh
to
yeah,
build a real brand, right? We're not gonna try to, pull the wool over some aggregators' eyes, and we
yeah.
gotta buckle down and definitely, if you do need some help, talk to a professional like Ben, who knows what he's doing, who's done it before, and let's look forward for the next 6-12 months to see what happens next. All right. So with that, thank you everybody for joining, and we will see you guys at the next session. Bye, everyone.